Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, everyday language. I'm your host, AlgoBot, and in today's session we're exploring an expert advisor called Triangular Parity Arbitrage. This is a statistical mean reversion strategy built for foreign exchange cross pairs. It leans on a rolling z-score of what's known as parity deviation, together with an average true range filter for its stops and targets. By the end of this video, you'll understand how the triangle is built, how the signal is measured, and how the entries and exits are managed. Remember, everything here is educational only. Let's dive in. So what exactly does this expert advisor do? At its heart, Triangular Parity Arbitrage is a mean reversion system that trades liquid non-dollar currency crosses. Think of pairs like the euro against the British pound, the euro against the yen, or the pound against the yen. The clever part is where its signal comes from. A cross rate is not really an independent price. A pair such as euro-pound is mechanically linked to the US dollar through its two legs, the euro's value in dollars and the pound's value in dollars. Divide one by the other, and you get a synthetic, or fair, price for the cross. Because those three prices are quoted by separate order books, tiny gaps in timing and liquidity can push the actual cross slightly away from this synthetic parity. The strategy measures that gap as a relative deviation, then standardizes it into a rolling z-score over a configurable lookback window, which defaults to 120 bars. When the cross drifts far enough from its fair value, the z-score stretches, and the strategy looks to fade that dislocation, expecting the triangle to reclose. In practical terms, when the cross is richer than its synthetic parity, the strategy signals a sell. When it's cheaper, it signals a buy. Every position is protected by an average true range stop and given an average true range profit target, and trades are closed early once the z-score collapses back towards zero, meaning parity has been restored. This approach is generally suited to shorter time frames, from 1-minute to 15-minute charts, where the dollar legs are deep and the parity bond is tight. It's best thought of as a study in statistical, market-neutral thinking, rather than a directional bet on any single currency. As always, this is educational information only, and trading carries real risk, including the risk of loss. Let's walk through the mechanics step by step. First, the expert advisor builds the triangle. It takes the primary cross symbol, splits it into its base and quote currencies, and works out the standard dollar pair for each one. Some currencies, like the yen or the Swiss franc, are quoted with the dollar first, so their price is inverted to express 1 unit in dollars. Others, like the euro or the pound, are used directly. If the symbol isn't a genuine non-dollar cross, or one of the dollar legs isn't available, the strategy simply stands aside and stays flat. Once the legs are ready, on each newly closed bar the EA reads 3 synchronized closing prices, the cross itself, and its 2 dollar legs. It computes the base currency's value in dollars, divides by the quote currency's value in dollars, and that gives the synthetic parity price. The deviation is then the difference between the actual cross and this synthetic value, expressed as a relative fraction. Next comes standardization. The strategy keeps a rolling history of these deviations and, over the lookback window, calculates their average and standard spread. The current deviation is converted into a z-score, which simply tells you how many standard deviations the cross sits away from its recent normal relationship. Now the signals. To open a short, the z-score must be at or above the EntryZ threshold, which defaults to 2, and the raw mispricing must exceed the minimum edge filter measured in basis points. That means the cross is meaningfully rich versus parity, so the strategy sells, expecting it to fall back. To open a long, the mirror applies, the z-score at or below negative EntryZ, with the edge stretched the other way, so the strategy buys a cheap cross. Before any entry, a spread filter blocks trades when the cross spread is wider than the allowed maximum, avoiding costly fills. Risk control is handled by the average true range. The protective stop is placed a multiple of ATR away from the entry, 2 times by default, and the profit target sits a larger multiple away, 3 times by default, giving a reward-to-risk ratio of 1.5 to 1. Finally, the exits. A position is closed once the absolute z-score falls back to the exit z level, meaning parity has been restored, or when the hard time stop in bars is reached, So the strategy never marries a dislocation that refuses to close. And only one position is held per triangle at a time. Let's look at the actual MetaQuotes language code that drives this, as you'd see it in MetaEditor. At the top are the input parameters. Lookback sets the rolling window for the z-score, defaulting to 120 bars. EntryZ, defaulting to 2, is the z-score needed to fade a mispricing, while ExitZ, at 0.5, closes the position once the gap converges. Mean-reversion is the minimum mispricing in basis points worth acting on. Then come the average true range settings, the period, the stop multiple of 2, and the target multiple of 3. There's also a maximum spread filter, a maximum hold in bars, the trade volume, and a magic number that tags the EA zone positions. Below the inputs are the two signal blocks. The short block reads, if Z is greater than or equal to EntryZ, and edge is greater than or equal to the minimum edge, then the cross is rich versus parity. The code takes the current bid price, sets the stop loss a stop distance above entry, sets the take profit a target distance below entry, and calls trade.sell. The long block is the mirror image. If Z is less than or equal to negative EntryZ, and edge is less than or equal to the negative minimum edge, the cross is cheap. It reads the ask price, places the stop below entry, the take profit above entry, and calls trade.buy. Notice how both the stop and target distances are simple multiples of the average true range, so protection adapts to current volatility. That's the whole engine in a few lines. This is educational only, not a recommendation. Let's bring this to life on a chart. The candles show a non-dollar cross, and beneath them is our key indicator, the parity deviation z-score. Watch how it moves between the green buy zone below -2 and the red sell zone above +2, with the dashed exit band sitting near 0. We begin with the cross drifting lower. Over the first two candles, price slides down and the z-score falls with it, dropping from around -1 toward -2. What this is telling us is that the actual cross is becoming cheaper than its synthetic parity, the fair value implied by the $2 legs. The gap is widening. On the third candle, price prints a fresh low and the z-score dips below -2 into the green sheep zone. This is the long condition being met. The cross is stretched well below parity, and the edge filter confirms the mispricing is bigger than ordinary noise. The buy entry marker appears here. The strategy is not predicting the trend. It's leaning on the idea that the triangle will reclose and the cross will drift back toward fair value. At the same moment, a protective stop is placed a couple of average true range multiples below the entry, just beyond that fresh low, in case the dislocation stretches further. Now watch the reversion. Across the next few candles, price bounces and climbs steadily, and the z-score lifts out of the green zone, back through -1 and toward 0. Each step up means the cross is closing the gap on its synthetic parity. By the sixth candle, price has reached the take profit target, a larger average true range multiple above entry, and the z-score has collapsed back to around 0. Parity is restored, the position is banked, and you can see the take profit marker. That's the full life cycle of a long, cheap, entry, convergence, exit. But the move doesn't stop at fair value. Price keeps pushing higher, and now it overshoots to the other side. On the seventh and eighth candles, the cross climbs above its synthetic parity, and the z-score rises through +1 and up past +2 into the red rich zone. This is the short condition being met. The cross is now meaningfully richer than parity. The sell entry marker appears on the eighth candle, and a protective stop is set a couple of average true range multiples above, just over the recent high. From there, the triangle pulls the cross back down again. Over the following candles, price eases lower, and the z-score falls out of the red zone, back through +1 towards 0. The cross is converging on its fair value once more. By the 11th candle, price reaches the short's take profit target below, and the z-score has settled back near 0. Parity restored again, so the position is closed at the take profit marker. Notice the symmetry. Both trades used exactly the same logic in mirror image. Wait for the z-score to stretch beyond 2 standard deviations, confirm the edge is real, fade the dislocation, and then let convergence towards 0, or the average true range target, close the trade. The reward to risk on each was roughly 1.5 to 1, from the 3-to-2 ratio of target to stop multiples. And crucially, neither trade needed the market to trend, only for the triangle to do what triangles tend to do and reclose. Of course, dislocations don't always converge, which is exactly why the stop and the time exit are there. This is an illustration for learning, not a forecast. And that brings us to the end of our look at the triangular parity arbitrage expert advisor. Today we unpacked how the strategy builds a currency triangle, how it turns the gap between a cross and its synthetic parity into a rolling z-score, and how it fades stretch dislocations with average true range stops, profit targets, and a convergence-based exit. Remember, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. All trading involves real risk, and losses do occur. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss what's coming. You can find more analyses over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.